Lehman Brothers did not collapse because of one bad weekend. It collapsed because trust ran out. Lehman Brothers survived wars. It survived recessions. It survived more than 150 years of financial history. Then, in just a few days, it disappeared. Not because all of its assets vanished overnight, but because something far more valuable vanished first. Trust. On paper, Lehman had hundreds of billions in assets. It had history, reputation, global clients, and a name that had survived wars, depressions, and market crashes. But in September 2008, none of that was enough. Because when lenders, investors, and counterparties no longer believe your assets are worth what you say they are worth, size stops being protection. It becomes exposure. That is the uncomfortable lesson behind Lehman Brothers. The fourth largest investment bank in the United States did not simply fall. It revealed how fragile the entire financial system had become. Lehman was not just a Wall Street company. It was connected to banks, hedge funds, money market funds, repo lenders, derivatives counterparties, and global investors. When it failed, the shock moved through the financial system like a warning signal. If Lehman could fail, who else was safe? That question froze trust. And in finance, confidence is invisible until it disappears. So let's walk through this like a financial autopsy. Not just the final moment of death, but the symptoms, the disease, the ignored warnings, and the trigger that finally brought the giant down. Lehman Brothers filed for bankruptcy on September 15, 2008. It reported roughly $639 billion in assets and more than $600 billion in debts, making it the largest bankruptcy proceeding in U.S. history at that point. But the collapse was not born that morning. It was built over years. The first layer was the housing boom. Cheap credit, loose lending standards, rising home prices, and huge demand for mortgage-related investments created a dangerous belief. Housing was safe because housing prices kept going up. Mortgages were packaged into securities. Those securities were sold to investors around the world. Rating agencies gave many products high ratings. Banks and investment firms treated mortgage assets as profit machines. But here's where the story gets darker. Risk does not disappear because it is packaged, rated, and sold. It only changes hands. When housing prices were rising, the machine looked brilliant. Borrowed money amplified returns. Confidence grew. Everyone looked smarter than they really were. Then housing prices started falling. Defaults rose. Mortgage assets became harder to value. Investors began asking a dangerous question. What are these assets really worth? For Lehman, that question was deadly, because Lehman had heavy exposure to real estate and mortgage-related assets. But exposure alone was not the full problem. The deeper problem was leverage. And this is the moment where Lehman's survival became almost impossible. Leverage means using borrowed money to control more assets than your own capital could buy. It can increase returns when prices rise, but it also magnifies losses when prices fall. Imagine a tall skyscraper built on a thin foundation. In calm weather, the height looks impressive. When the storm comes, the foundation matters more than the view. That was Lehman. The firm was large, but the structure was fragile, and leverage becomes especially dangerous when the assets behind it are difficult to value. If everyone agrees your assets are valuable, lenders keep lending. Counterparties keep trading. Investors stay calm. But when people start doubting the value, the entire structure can change quickly. This is where liquidity enters the autopsy. Liquidity is oxygen. A company can have assets, history, and reputation, but without liquidity, it cannot breathe. Lehman depended heavily on short-term funding, including the repo market. Think of a repo as a short-term loan backed by securities. It kept Lehman's financial engine running, but like any engine, it stopped the moment lenders lost confidence. For investment banks, repo funding helped finance huge balance sheets. But repo funding depends on trust. If lenders trust your collateral, the machine keeps moving. If they doubt it, they demand more collateral, raise haircuts, or refuse to roll the funding. That is not a traditional bank run with ordinary depositors lining up outside a branch. It is a modern institutional run. And almost nobody saw it happening in real time. No crowds at the counter, just lenders, counterparties, hedge funds, money market funds, and clearing banks quietly pulling back. And for a firm like Lehman, that can be fatal. A company can look solvent on paper and still die because it cannot fund itself tomorrow morning. Lehman did not need every asset to instantly become worthless. It needed confidence to continue, and confidence was disappearing. Then came the issue of opacity. At the exact moment investors needed clarity, Lehman's balance sheet was difficult to trust. One reason was a controversial accounting maneuver known as Repo 105. In simple terms, Repo 105 temporarily moved billions of dollars off Lehman's balance sheet before reporting dates, making leverage appear lower than it really was. Think of it like cleaning the living room right before guests arrive by hiding everything in the closet. The room looks cleaner. The mess did not disappear. That matters because financial statements are trust documents. When the market suspects the numbers are foggy, every number becomes a question. And when every number becomes a question, lenders act first and investigate later. Lehman did not die because one number went bad. It died because the market stopped trusting the numbers. The next layer was complexity. Lehman wasn't connected to one institution. It was connected to thousands. That's why one bankruptcy became a global financial crisis. That is how a bankruptcy becomes contagious. Modern finance is built on promises, contracts, collateral, and confidence. If one major counterparty fails, others must ask whether their own positions are safe. And when every institution protects itself at the same time, the system can freeze. This is the difference between a company problem and a systemic crisis. Lehman's failure hit money markets, derivatives markets, repo markets, banks, investors, and households. One important example was the Reserve Primary Fund, a money market fund that held Lehman-issued securities. After Lehman's bankruptcy, the fund broke the buck, meaning its net asset value fell below $1 per share. That frightened investors because money market funds were widely viewed as cash-like and safe. Suddenly, the panic was not just about Wall Street banks. It had reached places people thought were safe. Now many people ask a fair question. Why wasn't Lehman rescued? That question is still debated. Bear Stearns had been supported earlier. AIG received support right after Lehman failed. So why did Lehman go into bankruptcy? The answer is not simple. There were legal limits, political pressure, moral hazard concerns, uncertainty about Lehman's losses, and failed attempts to find a private buyer. Officials feared that rescuing every failing institution would teach Wall Street that risk would always be protected by taxpayers. But letting Lehman fail created a different problem. The market did not see discipline. It saw uncertainty. If one firm could be rescued, another allowed to fail, and another rescued the next day. Investors did not know what the rules were. And markets hate uncertainty during panic. This is why Lehman became more than a bankruptcy. It became a signal that nobody knew where the floor was. The broader 2008 crisis became the deepest downturn since World War II. Jobs disappeared, portfolios fell, credit tightened, homeowners faced foreclosure, and ordinary families who never bought subprime mortgage products still paid the price. If we bring this back to a cafe table, the personal lesson is not complicated. Never confuse size with safety. Never confuse debt with strength. Never confuse rising prices with permanent wealth. And never build a life, company, or economy that can only survive if everything keeps going right. Lehman shows us that leverage is not evil, but it is unforgiving. Debt can build wealth when cash flow, reserves, and risk are understood. But debt becomes dangerous when it depends on asset prices rising forever and lenders staying confident forever. The same principle applies to households. A family buys a house with little savings, uses credit cards to maintain a lifestyle, and assumes income will keep rising. Everything works while paychecks arrive and prices rise. But if income drops, payments increase, or the asset loses value, the whole structure feels different. That is the household version of leverage. Borrowed stability is not the same as financial strength. A business can make the same mistake. It may have inventory, sales, and customers, but no cash reserve. If suppliers tighten terms or customers delay payment, the business can fail even while it owns assets. That is liquidity risk. You can own valuable things and still be in trouble if you cannot meet today's obligations. Investors make the same mistake when they trust ratings or famous names without understanding what they own. A product can look safe because someone rated it safe. A company can look safe because it is large, but safety is not proven during good times. Financial strength is revealed when liquidity disappears. This is the perspective shift. Most people think the 2008 crisis was only about bad mortgages. Bad mortgages were the spark, but leverage was the fuel. Short-term funding was the dry wood. Complexity was the smoke. Weak risk management was the ignored alarm. And the loss of trust was the fire that consumed the building. Lehman Brothers was not killed by one bad weekend. It was killed by years of debt, hidden risk, real estate exposure, short-term funding dependence, accounting opacity, and confidence disguised as strength. Every warning sign had already appeared. The market simply stopped believing they could be managed. The final cause of death was trust. Once trust disappeared, the assets were no longer enough, the reputation was no longer enough, and the size of the institution made the panic worse, not better. That is the financial autopsy. So what should an ordinary person learn from it? Keep liquidity. Know your debt exposure. Do not assume assets can be sold quickly at full value. Avoid depending on one funding source. Be careful with anything you do not understand. Build a margin of safety before you chase aggressive growth. Cash reserves are not lazy money. They are survival money. The time to reduce risk is before everyone panics. The time to understand what you own is before prices fall. The time to ask what could go wrong is when everything seems to be working. Because in good times, risk often looks like intelligence. But in bad times, risk reveals the truth. Lehman Brothers collapsed because it built a financial empire on leverage, confidence, and assets that became impossible to trust. A system can look strong from the outside and still be fragile underneath. A balance sheet can look large and still be vulnerable. A market can look calm and still be full of hidden pressure. And a financial life can look successful while depending too much on debt, rising prices, and perfect conditions. So the question is not only what killed Lehman, the deeper question is this: where in your own financial life are you confusing confidence with safety? Because the lesson of 2008 is not that risk should be avoided completely. The lesson is that hidden risk eventually becomes visible. And when it does, liquidity, transparency, discipline, and margin of safety matter more than appearance. If this changed how you think about money, subscribe to Financial Awaken with Aaron for more insights that break down the hidden systems behind wealth.